Between March and June, mortgage rates have almost doubled, but recently mortgage rates have declined even after the Fed raised rates in July. What is going on and what can you expect with rates going forward? I'm Shaheedah Hill, getting you over the hill to home ownership and helping you confidently buy your first home. I'm going to try to explain where rates are going and how you can prepare for either higher rates or lower rates. Let's get into it, but I have to start with a 10-year yield. It is a little bit complicated, but stick with me. I'm going to do my best to explain because this is going to help you understand why rates are so volatile right now and what you can look forward to in the future. In order to understand yields, you have to understand the two primary types of investments, either stocks or bonds. Now, stocks are ownership in a company. So when investors are buying stock, they're buying ownership in a company, and they're thought to be more risky than bonds. When people buy bonds, especially government bonds, and that's what we're going to be talking about, when people are buying bonds, they're actually lending money to the government. So they're thought to be very, very secure. And that's where investors go when they want to make sure they don't want to lose money. When they don't have really good confidence in the stock market, they go to the security of bonds because they're backed by the government, governments pay back their bonds. So if you're going to go for risky things, but the potential to make more money, you're going to go for stocks. If you're going to go for more security, but you'll make less money, you want to go to bonds. So depending on how well the stock market is doing and how well the economy is doing, investors are moving usually to either stocks or they're moving to bonds. And the 10-year yield is a yield or a rate that your mortgage rate is tied most closely to. So when that 10-year yield goes up, then your mortgage rates are likely to go up. When the 10-year yield goes down, your mortgage rate may go down. But what makes that yield go up and down is what investors think about the economy. So let me go over the two graphs that I've prepared for you. Investors feel good about the economy and the market. They buy less bonds and mortgage rates may increase. But on the flip side of that, when investors are worried about the economy and they're looking for safety, they buy more bonds, and bonds yields will decrease, and usually mortgage rates will decrease with that. So rates declined recently, even after the Fed raised rates. So what happened? A part of what happened last week, so the Fed did raise rates, but it wasn't a surprise that they were going to raise them 75 basis points. They had been saying over and over they were going to raise rates, and probably it was going to be 75 basis points. They do this purposely. They have press conferences. They come out and do interviews because they don't want the market to be shocked by what they're going to do. So they prepare the market for what they're going to do. So when the Federal Reserve raised rates, that 75 basis points, nobody was surprised, and they had already made that into your interest rate. So there wasn't going to be a big swing in interest rates when the Fed raised the rates because they were already aware of what was going to happen for several weeks, if not a month ago. Now, there was more news that came out later in the week, and that was the GDP numbers and whether or not we were in a recession. So when those numbers came out, it showed negative 2 quarters of negative growth. And that typically is the technical definition of a recession. And so when investors heard that, they went to bonds, and because they wanted that security, and that lowered mortgage rates. However, now, a lot of, more positive data came out later, and they went back to stocks. So a lot of the stock market investing, was more people invested in the stock market. So they didn't need, the safety of bonds anymore. So you had that volatility where when they said recession, people went to bonds and that lowered the yield. And when people felt like, oh, maybe the recession's not that bad, there's a lot of employment numbers are good, and they went back to the stock market. So you're going to have that volatility, especially whether or not we're going to be in a recession, how long that recession is going to be. All of those things are going to impact whether investors go to bonds or whether they go to stocks. And that 10-year yield will tell you that safety. One of the websites I really like when you're trying to track where rates are going is the Mortgage Report. And they do a really good job of explaining where rates are expected to go, especially since COVID. We've had very volatile markets after COVID. So they give you a good idea of what's going to happen. They also recommend a rate lock, whether you should lock your rate depending on how close you are to closing. And you'll see here, they even have you should float your rate. And they haven't had this in a long time. Typically, they're telling you to lock your rate, lock your rate, lock your rate. But this is the first time I've seen in several weeks where they're recommending that you float your rate. So I really recommend this website as one you should watch as you're going through the buying process. If you have any questions, I hope this was a little bit clear. I'm going to put a lot of links in the description if you want to do more research on the 10-year yield. But this yield number is most closely related to whether rates go up or rates go down.